Ready? All right. This one? That work? You guys hear me all right? I hate standing behind a podium. I feel like I'm giving I don't know, speech of some sort. I guess I am. Okay. Uh, my name's Nate Sponenburgh. I own an accounting firm here in town, Sponenburgh and Company. Guess I'll tell you a little bit about me. I went to Utah State University for my undergrad and my graduate degrees in accounting and taxation, and then went to work for PwC, PricewaterhouseCoopers in 1999. Actually, I'm kind of old. I was there for a while, and can't hear me. Can everybody hear me? Is there a way to turn it up? All right, how about that? Cool. So yeah, and I tend to kind of migrate around, so hopefully I'll remember to stay in front of this thing. Anyway, I went to Utah State, went to work at PricewaterhouseCoopers in Salt Lake, and then one of my clients that I'd moved on to a smaller firm in about 2004, and one of our clients was Castle Rock, the dealership here for all those years. And I knew the owner from when I was a kid, ended up working for him, or he ended up being one of my clients. And then they had the dealership here, one in Afton and one in Salt Lake at the time, and he needed a CFO. So he talked me into moving to Evanston. He calls me one day and he goes, "So what do you think of Evanston?" And I go, "I don't." So he convinced me to move up here, and we moved here in 07, and I worked there for about a year, and then realized really quickly that there was only one other CPA in town. He was 60 plus years old at the time, and I thought I should just open a firm here. So we opened in 08 and have been here ever since. So really like Evanston other than the weather. That's very agreed upon with my wife. She absolutely hates the weather here, and for good reason, but we enjoy it here. It's nice. So tonight I'm here to talk about some basics in accounting and taxation, and kind of wanted to go over, a few different things structure-wise and things like that. Some of the biggest things that I see questions on and pitfalls in my practice with small businesses. Our practice is mostly centered around small businesses. We do a lot of individual tax returns as well, but the meat and potatoes of our office is business consulting and small business consulting, taxation, those kinds of things, retirement planning, do a lot of that stuff. So let's get started, I guess. So the first thing, everybody here, first of all, congratulations. You guys are officially, if you're wanting to go out on your own, probably doing one of the best and definitely one of the worst decisions in your life. Running a business is extremely stressful, and you wear a lot of hats, especially as a small business owner. So first to start off is, first of all, you get a business idea. And when my kids were young, there was a movie called Robots. Did you guys, anybody see that? And it's the big fat robot who was the entrepreneur and kind of the Oz of the ground, and everything. And he had this saying, and I thought it was so good. He said, "Find a need and fill a need." And that's what you guys are doing, with starting a business. Find a need and you fill it. You gotta be able to sell it. You gotta be able to make money off of it. You gotta make sure everything's done right. So find a need, fill a need, and then when you do that, you gotta know what it is that you do well and do that. Hire other people to do the other stuff. You'll find out as a business owner that you wear so many hats. I mean, I even had it in my business, right? Like, I was finding out that I was probably spending outside of tax season, I was spending about 60 to 70% of my time just doing administrative stuff to manage my own practice. And that's not what makes us money. I make money consulting and doing things like that with my clients. And I found out real quick that, oh my gosh, I was spending, 60% of my time could have been spent dealing with clients and helping them instead of just doing my own stuff. So about 3 years ago, I hired an office manager to offload a bunch of my admin stuff. And it's one of the scariest decisions I ever made, because I'm hiring somebody and paying them a salary and giving them benefits and everything to a person that doesn't generate $1 of revenue for me, not directly anyway. But she was able to free me up to where I could then spend that time doing stuff that mattered for clients and stuff like that. So get help with the rest of those things. And that's probably the hardest thing to do when you start out a business, because money's tight. You're scared about spending it because you don't know where your next meal is going to come from, essentially. And I will say too that so I opened in 08, so I'm going on 16 years or so. I still worry if I'm going to be able to make payroll, right? It's just the nature of the beast. And I honestly think that if you ever get to a point when you're running your business that you're not worried about that kind of stuff, you're going to fail. You've got to have that internal angst to make you do things. So that's a good thing. The next thing is you've got to understand risk, how to calculate it, and what is risk. And so to kind of break that down as you guys are starting out, and I'm guessing you guys did business plans last week. Is that what they did? This kind of fits in with that. Define what your business goals are. Really sit down and what are your revenue projections? How do you want to structure your expenses? How do you got to look at that. So how are you going to market? So you need to define your business goals. You need to understand what those risks are. And there's financial risks and there's legal liability risks, right? So what are some of the businesses that are in here today anybody want to volunteer any of that? What are you? A what? Mobile mechanic. Great. There's a lot of risk to that, right? Physically, legally, financially, got to buy a bunch of crap, a bunch of capital, all that stuff to try and get set up. It's fun, isn't it? Anybody else? Something else like a service-based business? Anybody have anything like that? Fencing. Okay, cool. Still kind of the same. Got to buy stuff. You got to have equipment. Got to do those things. Good. So it's understanding what those financial risks are. And so like one of those things, kind of the best way to understand risk is like your interest rate, right? You go to the bank, you go see First Bank over there and say, hey, I need a loan to buy this equipment or buy these things. They charge you an interest rate, right? Do you know what that interest rate really represents? It represents the bank's risk in that you're not going to pay them back, right? And so that's a financial risk, okay? And then you got your legal risks. What happens if you ruin somebody's car or you put up a bad fence? It's not just in your product. You got product liability on whether or not you do good work, but there's also like, what if you hurt somebody? If you're a trucking business and you get in a wreck, or you've got to have those risks accounted for, and that's where insurance comes in and those kinds of things. But you really need to understand what those risks are, because you got to decide whether or not it's worth doing it, right? If you have good credit, the bank's going to give you a lower interest rate. If you have bad credit, you're a higher risk to them, so they're going to charge you more to borrow that money. And so understanding what risk really is a huge thing. Then you got to figure out, how am I going to market this to my market? What is my market? Who are my customers? How can I fill those needs for them? And then how do you find those people? How do you get them to come to you? That's really important. And then, so understanding your target market, and then just financial forecasting, which you kind of got into that, I guess, when you were last week with the business plan. That should be a part of your business plan, is forecasting and kind of figure it out. And yes, it's a swag, it's a guess a lot of the time. And then as you get more and more experience underneath your belt, you can kind of see where your trends are leading you and stuff like that. Okay, so you've got your business, you want to get all this set up. So then the next thing is, how should I structure this thing? And there's different types of business structures, and those are usually referred to like an entity selection. How do you want to be set up, and what does those things mean? So we'll go through the different things on that. The first is, you could just be a sole proprietor. You don't have to do anything with the state. You just got to hang a shingle out and say, okay, I'm building and putting up fences now, or I'm a mechanic. And you can go do that. So how are we going to report those things? A sole proprietor is just that. It's a single person, single individual. And this type of structure offers a lot of flexibility, and you have all the control. You can do whatever it is that you want to do with it. And then the question is, well, how do I report this on a tax return, or how do I report my stuff? That would go on your personal tax return, and you would be attaching either a Schedule C if it was one of these business types, or a Schedule E, which would be like rental properties. So you buy a rental property and you start renting it. That's reported on Schedule E. And the reason for the two different schedules is the taxability of each of those. So that's the first type. And there's two, I wrote next to their flow through, because what that means is that the business itself does not pay the income taxes on the earnings of the business. Those profits flow through to your personal tax return on the Form 1040, and that's where it gets taxed. That's where we calculate the tax on what it is that you would owe if you have any income in there. So that's a flow through. Now a Schedule C and a Schedule E, they are flow throughs, but they are schedules attached to your 1040. So they're part of your personal tax return. The next are partnerships. These are also flow throughs, and these are made up by 2 or more people. So you share responsibility and you share ownership of it. So if you're 50-50, you're both on the hook for the same amount. It could be 99.1, it could be 99.9 and 0.1, it can be 50-50, 60-40, however you split it up. And that's usually determined based on how much capital you're bringing to the table. So if Rocco and I were going to start a business, and we were going to do this as a partnership, and we needed $100,000 to start this up, and we're 50-50, we'd each have to come up with 50 grand to start the business, right? So it goes into your capital. Then you can agree in there, there's some control in there that you can have, there's some fluctuations, there's things that you can do. They're very flexible. I like partnership accounting, I like partnership tax law. By itself, it's actually probably one of the more perfect tax structures there are, from if you really tried to understand how that stuff is flowing around and going. And the default tax filing for a partnership is a Form 1065. So in this case, the partnership actually still files its own tax return, and then the net profit on that gets pushed out to your personal tax returns on Form K1s. And then you just put the K1 on your personal return to get it taxed, because you're still getting taxed on your personal tax return. So in Rocco and I's case, if he makes a whole lot more money than I do outside of the partnership, he's going to get taxed on a higher amount of his portion of the profits than I would, because it all flows into our personals, right? So tax planning for that is a little bit more difficult, especially when there's partners that everybody makes a different amount of money, that maybe somebody's spouse's work or makes different money or whatever it is. And if any of you have any questions, just raise your hand and throw it out at me, because I might just start talking a bunch. The next type is a corporation. Oh, and one other thing on the partnerships, you do have to form some sort of legal entity with the state. So that would be filed with the state. So whether it's an LLC, which I'll talk about in a little bit, or just a general partnership, those are pretty rare now because of liability concerns and stuff. LLCs are typically what you'd use for that, but you do need to file that with the state. And same thing with a corporation. So corporation, just the corporation itself is also a standalone entity. Or I'm sorry, no, it's not. It is a standalone entity, sorry. It's not a flow through. What that means is that the corporation itself actually pays its own income tax. So you file a corporate tax return for it. It's a Form 1120, whatever the net profit is. Right now, we're in one of the lower rates we've ever had at 21%. So if you make 100 grand in net profit, corporation's going to owe 21,000 in taxes for the year. So, and that's all taken care of in there. Nothing flows out to your individual tax return. And then the next thing, LLCs. And in Wyoming, we're cool because we invented that sucker. We are the ones who invented the LLCs, so limited liability companies. The unique thing about limited liability companies is we can tax them however we want. We just have to tell the IRS how we want to do it at the beginning. And so that's why I put on the default tax filing, it depends. And we'll go through that in just a second. Are there any questions on like structures or anything that pops out to anybody that they want to know a little bit more about? Rachel? Yeah.
Would it be more advantageous for me to like set up a different type of entity? Like, what's the most advantageous entity for me to set up?
Okay. So to pay your kids, really any of them. One nice thing though with the LLCs, yeah. I mean, if you're going to do payroll, you got to set up all the payroll stuff, and we'll go over payroll in a little bit too. But paying your kids, which is also a good tax planning idea, because I can shift income out of my tax bracket to my kids' tax bracket, which is usually zero if you do it right. One nice thing about an LLC, no matter how you decide to do it, so if you take an LLC and you tax it as a partnership or you tax it as a corporation, you can pay them and you won't have to withhold and pay in the FICA and Medicare, because you're an LLC. If you're set up as a corporation, then we'd still have to do the FICA and Medicare on the kids' payroll, just like everybody else when you get a paycheck, versus the LLC or a partnership. As long as they're minors, right, under 18, then we can get away without having to pay the FICA and Medicare. That's a great question. And that kind of will lead in a little bit later as we get into the employee stuff. But cool, yeah. Oh, go ahead.
So we have basically a 50-50 partnership, but we're an LLC.
Okay.
So I guess I don't know the difference between an LLC and a partnership. Is it?
So great question.
You know my question.
No, that's a great question, because LLCs can be confusing, right? If you set up a multi-member LLC, so 2 or more non-spouse partners, right? So if me and my wife set up an LLC, the IRS says I can treat us as a single owner because we're married, right? Now, if you got 2 unmarried partners, the default tax filing for that LLC is a partnership. So you would still file a partnership tax return as an LLC. You probably did, and honestly, it's malleable. You can change that even years down the road. We can make different things. Go ahead.
Okay, I have a business and I've been found as an LLC, but I've also been found as a sole proprietor.
Yep.
Is that okay?
Absolutely.
And I've been using Schedule C.
So when you set up that LLC, and did you get a tax ID number for it?
Yes,
so when you did that, you said you were the only owner. There was only one of you, right?
No employees.
So the default for a single member LLC is what's called a disregarded entity, meaning that you'd file that as a sole proprietor on Schedule C.
So you said that you can like start out as like a sole proprietor, but later on down the road you can change it.
Oh, that's the easiest one to move from.
Okay.
If you start out as a sole proprietor, the difference too though between the sole proprietor and the other ones is, even though you have full control and full flexibility, you're personally liable because you don't have a business entity to give you that corporate veil. So setting up a single member LLC, like, what was your name? Deborah. Like Deborah did. She now has put in place an entity. It's a corporate veil, right? It separates her from her business. So if she does anything in her business that hurts somebody, or she's liable, and let's say she hurt, I hate to say this, but let's say you hurt me, right? And I sue you, and I'm suing the LLC. Even though she's filing that as a sole proprietor, but she has an LLC, I can technically only get at what the LLC owns, not her personal assets like her house and her 401k and those things. Sole proprietors aren't that lucky because you're a sole proprietor. So if you did something wrong in your business as a sole proprietor, all of your assets are at risk, not just the business assets.
I took a class in August and it was on asset protection trusts.
Okay.
Are you familiar with those?
Yes.
Okay. And he fits right into what you were saying with liability. Now, I think he said that you could put a sole proprietorship and a partnership into the trust assets from it. I don't remember if he said that you can do an LLC or not. Do you know?
Well, I think I'd have to get a little bit more familiar with the thing, but you could have the trust be the owner of that LLC or a partner in it if it's a partnership. Depending on the type of trust you have, and there's a bunch of different trusts, and how there's irrevocable, revocables. An asset protection trust, though, is typically more. It's
new. It's so new. It hasn't really been tested much yet. He said, and only Wyoming, Utah, and Arizona are doing them right now. And he said he was very disappointed in Wyoming because ours were better. But
really?
He said Arizona's is, yeah. He said Wyoming's usually better than everybody, but we don't have.
I've actually heard the opposite though on the trust, so that's interesting hearing that from an attorney because.
Well, yeah, because he does them. And,
yeah.
That's basically what he focuses on.
Because I'm the trustee on a couple of asset protection trusts from people that are out of the state that came to Wyoming specifically for that.
He gave us the example of a couple who were ripping people off, basically.
Wow. I think you have that risk at any.
And he said that they were taken to court, and even after the court's judgment that they paid back, they couldn't get some money.
Interesting.
They're so bulletproof. But he said that he was disappointed that he had to give that example, but just to show us that we can protect ourselves.
Sure.
As honest business owners from being sued by criminals.
Yeah, I mean, those are nice to try and put up some safeguards to try and protect your assets, but that also comes down to commingling of funds and being careful, right? Like, so even in an LLC partnership, if I have an LLC, say Deborah does, and you're buying your groceries, paying your mortgage out of your business account, you're puncturing holes in that corporate veil so that if somebody were to sue you, they'd say, yeah, you've got this LLC in place, but we think you've been using that LLC as your own personal piggy bank, so we want access to all your other assets. So just having the LLC is not the safeguard in and of itself, because you've got to follow the rules to make sure that you don't puncture holes in your corporate veil. That may be true. I don't know. I'm not a lawyer, but I still think even 10 years down the road, you got to make sure that you're still following those corporate formalities and that you're doing the things that you need to do so that you don't ruin the structure that you spent money on and made all this effort to put in place. I would think that an asset protection trust could own an LLC, and it could also it could be a partner in an LLC. It couldn't be in an S corp. Wouldn't want it to be that way, but you could in a partnership or an LLC. Now, if the LLC is taxed as an S corp, I don't think the trust could own the shares of the S corp on the tax side of things. I mean, and that's where it goes into next. I was going to talk about LLCs because that's the main thing that everybody does, right? So, anything else on just like the overall different structures of a business? Any questions or anything? Cool. So the next thing are LLCs. This is typically the go-to, right? More often than not, when a client comes in and want to form a business, more often than not, we settle on the LLC. Go through the different structures and what it is that we're doing. So first, like Deborah over here, she has an LLC. She taxes that as a flow-through or as a sole prop. So it still goes on Schedule C. She has an LLC to help protect the rest of her assets and separate herself from the business. And so that would be, and I meant to delete the back end of it, but single member would be on a Schedule C or E. The S Corp stuff I put down below, so I meant to delete that. Anyway, sorry. So just ignore from here on, and then we'll hit the rest of it. If you've got 2 or more partners, like back there, your default with the IRS, so when you get that EIN number and you said that you have 2 or more partners and you named it, said it as an LLC, The default on your EIN letter, it'll say that you need to file a Form 1065 by March 15th the next year, right? And that is the default for a multi-member LLC as a partnership structure. And you form that, you file that on a Form 1065. The next is the corporation. You can have an LLC that's taxed as a C Corp, as a standalone. Very rare. I don't usually see this. I have a lot of clients that we do, like we have a C Corp that owns LLCs, but you can also just form an LLC and then you can tell the IRS that you want it to be taxed as a C corporation. So for tax purposes, you got to follow the corporate formalities and all that kind of stuff. And that gets filed on a Form 1120. And then the most popular one that LLCs use, partnerships and S Corps, right? So the S Corp's an interesting thing because when you go to set up your entity with the state, there's no such thing as an S Corp. It's just corporation, right? You're setting up a corp. You go get your EIN from the IRS, you tell it it's a corporation, your EIN letter is going to say file a Form 1120. You're a corporation. If it's a multi-member LLC, the default is 1065. You're a partnership. If you want to be taxed as an S corporation, you have to file an election down on the bottom. You got to file a Form 2553 electing S status with the IRS. So the S Corp is really only an entity that exists with the IRS, not with the state. Now, some states have, I think Utah actually, if you go to form, you can tell them you're forming an S Corp, but you still have to do the IRS filing, right? Because when you go get the EIN, there's no S Corporation selection on the beginning when you're saying what the entity type is. It'll tell you if you want to make it an S Corp, you got to file Form 2553. And what 2553 is 100% of the shareholders. So if there's 5 of us that are shareholders in an LLC or are members of the LLC, and we want it to be taxed as an S corporation, we all have to make that. We all have to sign on the election that we're okaying the election to be made. And what that does essentially is it takes the corporation where it would have to pay its own income tax and turns it into a flow through to where it'll flow out to the personal returns of all of the owners. Okay. That's probably the most popular. And then the thing to kind of understand from a legal perspective, you're still an LLC. So if you were to get sued or any kind of lawsuit or anything that dealt with the law, you would be dealing with the LLC laws of the state, not the corporate laws of the state. It'd be the LLC statutes. Even though for tax purposes, you're a corporation. But then with the IRS, you have to look, smell, feel like a corporation. So you kind of have some differences there. In the partnership, Rocco and I can be 50-50. And if we decide it's okay for us to do a distribution of profits, and I say, you know what, I don't want to take mine today. Rocco says, I need $10,000. Okay, we distribute 10 grand out to him. Doesn't hurt anything in the partnership. We just track that in your capital account to keep us in balance at the end of the day. So if we were to ever sell the company, I'd have to get made whole first before we split the stuff 50-50. In an S corporation, this is also another main difference between an S and a C Corp. A C Corp, you can have multiple shareholder levels, right? You can have different classes of stock. So we could treat one shareholder differently than the other in a C Corp. In an S Corp, you can only have one class of stock. So in that same example, if Rocco took 10 grand and I didn't, that could put our S election in jeopardy because we've treated Rocco and myself differently at the shareholder level. So we're treating it as if there's 2 classes of stock and there really isn't. So you could lose your S election, and the bad thing about that, if you lose your S election, they kick you back into a C Corp, and the taxation's a lot worse, usually for small businesses to do that. So that's why I kind of expanded this year, because the LLCs you can do whatever you want with the dang thing. So is there a question? No? Saw Rocco jump up like a rabbit. Oh, okay. Rachel?
So when you file your 1065, does it show up as a line item on your 1040 and taxed as like individual taxed or is it taxed like Schedule C or something like that? Is it just a line item on your 1040 where you're taxed at the same rate, personal income tax wise, or do you know what I'm saying?
Yeah, I do. So, have any of you guys seen a Form K1? What they look like? Is there just one line on that form there? No. Yeah, and there's a bunch of schedules attached to them because it depends on what the partnership is doing, right? So if I have a rental partnership where I've got rental property in there, the net profit comes through on the rental line. So then that rolls through and gets taxed as if it's rental income to me. But if I have a mechanics business in a partnership and that's ordinary income, that comes through on the ordinary income line and that gets taxed. Not only am I paying the income tax on that, but I got to pay self-employment tax on that as well because it's like my wage, right? And so you do the partnership K1 and a product or a byproduct of the 1065 and the 1120S is a K1 form. And then we take that K1 form and then we go put that into your personal, and that shows up in a bunch of different places on your tax return. Because let's say the business has interest income, it's got rental income, it's got ordinary income, it's got capital gains from investments, it's got you sold an asset and we've got to recognize the gains on the sale of the assets. Those all come through on different places and they all show up differently on your personal tax return. So it's not just one number and you stick it on there. And if you look at your personal return, you'll see on one of the schedules it'll say income from K1s, but that's kind of in multiple places because it depends on the type of income that's coming out of that business. Same thing with the S Corp. They look a little bit differently, the K1s do, but in essence, they're kind of the same thing. So partnership files its own tax return, corporation, S Corp. Yep. Correct. So on the partnership return, you would show all your revenue, all of your expenses. You'd have a balance sheet on there showing all those transactions. But then it's just one single form that comes out to go to your personal return. So if you look at your personal return, you go to Schedule E, page 2, you'll see the partnerships or S Corps that you're involved with that you got K1s on, and that's the only thing that shows up on your personal return, which is nice from an audit perspective. Because if you're sole prop or filing on a sole prop and they audit your personal return, they're going to go through your business just as if they were looking at the LLC or at a partnership. So it's nice to kind of separate all the activity that they could want to look at is on that business return. They would have to open an audit on that business as well in order to do that. And the crappy part is audits are getting more and more common now. So, yeah. Deborah has a question.
Okay, since I have an EIN number, and if I start a new business, it's gonna be similar to an EIN number I have. Should I get a new EIN number, or should I use the same EIN number, but just get my certificate of articles, so I can open a different bank account?
Depends on the risk of each business. Like you don't want to have one business that's super risky compared to the other business, because if you combine them from a liability perspective, let's say you do one thing wrong in one business that carries more risk, and you're putting it all in the same LLC, then the whole LLC, all of its assets. So like if you talk to an attorney and they say you have different businesses going on, they would want an LLC or a corporation or something for each one to separate that liability. From a tax perspective, I don't care because it all gets netted down into one pot. So tax-wise, it doesn't hurt you to have it all in one. Legally, it could. So that's a great question. That's good. Anything else on LLCs before we go on to actual accounting? No. This is good. This is my meat and potatoes anyway. I like tax stuff. I don't know, as torn as I am with what Trump said the other night, it would sound good to not have an income tax system, but damn, I'd have to find another job. So, anything else on this? Cool. Fundamentals of accounting. Okay, so this is where it really gets kind of meat and potatoes for business owners, because this is the hard stuff. This is the stuff that you don't want to pay for, but it's probably one of, if not the most important thing to pay for to get help with. I had a boss once, I told the story last year. I had a boss once that I worked for, awesome guy. His name was Rick Hoffman. He's one of my idols. And he came to me at raise time and he says, hey, why don't you calculate your raise and come tell me what you think it should be. And I was like, oh yeah, I got this. Went through my billables, figured all that stuff out, how much revenue we're making off of me and what it would cost, you know, and what I'm currently getting percentage-wise versus what I was before, and put this great presentation together for him. And I go in there and I'm like, I deserve a 35% raise. I was confident, super confident. And he laughs and he's like, hey, this is a great presentation. This is good. And this is when I was doing litigation support. So I was in the report mode. I was doing graphs. This is awesome. And he's like, this is great. He goes, I'm going to give you a raise, not 35%. I think I did okay. I think I got 12 or something like that. But, you know, and he said to me, he goes, hey, you have a mortgage, right? I said, yeah. He goes, do you think Roger has a mortgage? Yeah. Does Corey? Yeah. Does Laura? Yeah. He names all my team that we work with. There was about 7 or 8 of us. And he goes, yeah, I have a mortgage too. And he goes, if you lost your job today, it would suck, wouldn't it? Got to pay that mortgage somehow. He goes, but I'd be confident you could find another job. It'd be great. He goes, if I lost my job, I not only ruined your mortgage and Roger's mortgage and Corey's mortgage. He goes, I worry about 10 mortgages. You only have to worry about 1. And man, that stuck with me, because I was just like, that's what it means to own a business, right? You invest everything into doing this, and you're going gangbusters for it. And if that business doesn't succeed, you have the potential to lose everything. And you know, if Rick had lost his job, and yeah, the 9 of us would be out of a job, he would too. But anything he had is all subject to being lost. And yeah, I would have been had I lost my job, but I could probably go find another one. It sucks. We've all gone through that. But that's what it means to own a business, right? You're investing your blood, your sweat, your tears into all this stuff. So, and the scary thing is that 4 out of 5 fell in the first year. So, I mean, if you do fail, doesn't mean you can't do it again, right? Keep going after it and learn from those mistakes. And that's where it kind of comes into the accounting. It's the one thing that people don't want to pay for, but it's probably the most important thing there is, because if you don't know how your business is doing, how can you make decisions, right? So understand an accounting process. It's recording, summarizing, and analyzing the financial transactions to provide viable insights into decision making, right? How do you know if you should go into a certain market? How do you know if you should buy a certain tool or a certain piece of machinery or whatever it is that you need to run your business? Should I rent an office? Should I buy one? Should I do this? Should I do that? If you don't know where your financial position is, and honestly, the first thing that Benton's going to ask you for at the bank is your financial statement and your tax returns, because they got to decide whether or not what interest rate they're going to give you because of how much risk you pose them, right? And then understanding key accounting principles. So it's really essential for you to be able to effectively manage your company if you don't understand just what key accounting principles are. And the basis for all accounting is called GAAP, Generally Accepted Accounting Principles. GAAP is the foundation of all financial reporting. If you look at it, if you go on the Edgar website to look at financial statements for publicly traded companies, those are all in GAAP. So you can read them, and what that does is it provides us an ability to be able to consistently read. Like, I can go and compare Coke and Pepsi's financial statements because they're relatable, right? And they're all following the same standards. So relevance, reliability, comparability, ensuring accuracy in financial statements, and that's what GAAP accounting does. And it's critical for maintaining integrity and transparency. If I go to David with my financial statements and they don't look right, he's not going to give me a loan, right? There's no way. And this is where it comes down to, and I guess I gotta be a little careful there because I never want to insult anybody, but there's a lot of bookkeepers out there, and I put them in quotes, that say, oh yeah, I know how QuickBooks works. I can download your transactions, classify them for you. But if they don't have a freaking clue how it shows up on the balance sheet and the income statement and those things, they're no good, right? And one danger in that is that they just, they're giving you a false sense of security if you don't have a competent person actually taking care of your accounting. And financial management, right? So, to be able to manage your company from a financial perspective, you got to have good data. You got to have good things. So we'll go into what those financial statements are. And there's 3 key ones that you don't necessarily have to know how they get generated, but you need to know what they're telling you, right? So the first one is the balance sheet, right? Summarizes your assets, your liabilities, and your equity or your capital at a particular point in time. So the best way to describe a balance sheet to somebody is, I use a house example, right? So let's say you're going to go buy a house. It's a $400,000 home. You put $100,000 down and you borrow $300,000. Tell me what your balance sheet looks like. Well, I got a $400,000 asset, and I got a $300,000 liability, and I have $100,000 in equity. Everybody understands equity, right? It's like, okay, I'm going to buy a house. I put $50,000 down. I got $50,000 of equity in my house. Same thing with a business. It's got assets, it's got liabilities, and it's got equity, right? And the formula for that is assets equals liabilities plus equity. So your assets better equal the sum of your liabilities and your equity. And funny enough, like I've seen tax returns in the past done by other people when they're coming over and they bring in their partnership or their corporate return, and I go look at the balance sheet on there and it doesn't balance. Like, it's in the freaking name. It says balance sheet. So, and understanding what that thing tells you. So if I have more debt, so let's say I have a $400,000 house, I have a $500,000 debt on it, I have a negative equity of $100,000, right? This balance sheet just in and of itself says, does this business have enough assets to pay its liabilities, right? That's it. Converting some of those assets to cash to pay the liabilities might be an issue, but do I have assets that equal my liabilities or are greater than my liabilities? And the other problem one problem with the balance sheet that I think a lot of people have a time understanding, if I bought a house 5 years ago for $400,000 and now the house is worth $600,000, I don't adjust my balance sheet to say that I have a $600,000 home, right? Because that only happens if I sell it. If I sell it, then I have a gain there that makes up that difference. But so it is a historical perspective when you're looking at a balance sheet. Any questions on a balance sheet? This is probably the most boring Wednesday night you guys ever thought you would have. Okay. The next one is profit and loss, also called an income statement. One thing on the balance sheet, right? That's a snapshot of a particular date. So I'd be looking at my balance sheet on December 31st, 2024. These were my assets, these are my liabilities, and this is my equity. Profit and loss looks over a period of time, typically a calendar year, right? So January 1 through the end of the year, or if you're looking at it quarterly or monthly or whatever. It's how much revenue came in over that time period and what were my expenses. Okay? And then that gives you your net profit, so revenue minus expenses. Okay? The next is a cash flow statement. And the reason why this is so important is sometimes when you're making a payment, right? So let's say I have a $300,000 in debt and I've got a debt payment to good old First Bank over here. And when you look at your payment to the bank, a percentage of that is interest and some of that's principal, right? So if I were to put that onto my financial statement, if I'm reducing my debt with any of my payment, that would go to the balance sheet, right? Because it's going to reduce my liability. The interest portion goes to my income statement. So when I'm looking at my income statement or my profit and loss statement, if I know I have a $3,000 a month payment, I'm not seeing all $3,000 show up on my income statement. So I might be showing profit, but I feel like I don't have any cash because I was paying down debt too, right? So that doesn't show up on the income statement, and because it's split between the income statement and the balance sheet. So that's where the cash flow statement comes in, because what this does is it shows the difference of all, it tracks the ins and the outs of the cash and how you were using the cash. And that cash flow statement, you have your beginning cash and your ending cash, and then you say how you got there with your ins and your outs. So if your cash is going down, you would know it, right? Because I get that question, I get that a lot at tax time. It's like, how do I have $20,000 in profit? I have no cash left over. What were you paying down debt? Yeah, okay. That's not a deduction cash-wise, because we're depreciating those assets, and a depreciation of capital doesn't match when you're actually paying it, right? Because under tax laws, I might be able to deduct the whole asset in the year I bought it, even though I got a 5-year note on it. So I'm still paying those payments, but I've already deducted all the principal of my loan that I'm paying down the road. So understanding where your cash is huge. And I think most people kind of instinctively does that, because, I mean, how many of you guys in here actually still reconcile your personal bank accounts? No, you look online and see what the app tells you. You have cash-wise in your cash account, and whether or not you can spend it or not. But that number that's in your bank account isn't what you're going to be taxed on. It's just not. They're different. So you need to at least understand how these financial statements and what they're telling you as a business owner. You may employ somebody or hire somebody to take care of the accounting to generate these, but you got to understand what they're telling you. Because if you don't understand what they're telling you, then how do you make decisions for your business, right? Cool. Anything else on this? Any questions, I guess? Go ahead.
Okay, so what line item on like a profit and loss or balance sheet do you see the most off? Like what?
Off?
Yeah. Like what line item do you think is the most important to keep track of on your financials?
Oh man, what's most important? Depends on what your objective is, right? So if you're worried about, like, let's say you guys did your business plan and you projected $200,000 of income and you only hit 100. Okay, why? So I'd be concentrating on that and trying to figure that out. Maybe you hit your revenue line, but your profit's lower than it should be because you've got too much in expenses. Or maybe your profit and loss looks great, but you have no cash because we're not looking at our cash flow statement, right? So it really does depend in the moment. The thing that I see off the most, it's usually in the setup of the books, especially in QuickBooks. As much as QuickBooks tells you all that you can be your own accountant, they're full of crap, because they try to make it so easy so that you don't have to understand the debits and credits that actually happen in an accounting system, because they try and do that in the background where you're just saying, oh, look, I downloaded my bank statement, or I generated my invoices and stuff like that. If it's not set up correctly, because I'll get into books and go pull a P&L or a balance sheet, there's negative liabilities, there's negative assets, or there's negative revenue and negative expenses because the chart of accounts wasn't set up correctly. And so with my staff that are doing the bookkeeping side of my business, especially on the payroll side, when they get done doing that, I want them to go look at the financial statements to make sure that you pull a P&L and that you don't have a negative expense, or you don't have did you do something wrong, right? And debits and credits are different in your point of view than they are at the bank's point of view, right? Because you'll hear the term, they debited my bank account. What does a debit to your bank account mean in your mind? Anybody know? Huh? Withdrawal. Accounting, that's an increase, right? So if I were to journalize, if I got paid on an invoice, I debit my cash account so it goes up, and I credit my receivable so that it goes down. So under debits and credits, they're the same side of the ledger, but when I'm looking at if I look at a balance sheet, debits increase my assets, but debits decrease my liabilities, and they decrease my equity. Credits decrease my assets, and credits increase my liabilities, and they increase my equities. And then on the P&L side, revenue to go up is a credit, expenses are debits, right? So everything balances, everything's double entry. And I'm on the board at State Bank, and I'm a shareholder there, and it's been very awesome to kind of see. I've always I've understood that we used to always say, "Oh, bankers are backwards." They're actually not. The reason that they say debit is because on their books, if I go put $10,000 into my bank account and they say we debited your account or we credited your account for that, on their side, it's a liability. On my side, it's an asset. So when he says that he's credited my account, you just hear credit, and from an accounting point of view, I'm like, oh, that's going down. No, their credits went up because they owe us. My assets went up, so it's a debit to me, right? And understanding that from a business perspective, it's bankers aren't backwards; they're following GAAP as well. It's just which side of the ledger are we on? Because it's an asset to me, and they owe me that money because I put it in their bank, right? So it's just different. And there's just debits and credits suck. You just got to know debits and credits. So anyway, you just got to understand what these financial statements are telling you. Whether or not you're the one to build them, you want to be the one to understand what it is they're telling you. Okay. All right. So the next thing is, well, how in the hell do I do my accounting then? Right? What am I going to use accounting system-wise? The most popular? QuickBooks. All right. I freaking hate QuickBooks, but I use the heck out of it, right? It's the most common software that I use. The major problems I'm having with QuickBooks right now is that they're getting rid of the desktop version. And their online product is nowhere near ready to replace the desktop version. I really like their desktop product. It works great. Well, you could do that. The problem is you lose some functionality after 3 years, right? So if you're doing payroll, you can't do payroll in there anymore. If you're doing downloads from the banks to download your bank statements, stuff like that, it won't work after 3 years because they cut off the support for it. And they're pushing everybody to their online stuff. And especially in their payroll module, it's riddled with issues. I don't like that I can't control the payroll side. Because in the desktop version, if I set up and do payroll, and at the end of each year, you get a letter from the state saying, here's your new unemployment rate and here's your new workers' comp rate. And you can go in there and put that in there. Even if you're the admin on the account, you have to call QuickBooks Payroll for them to just update your rates. And if it's not set up properly, online's a lot harder to fix than the desktop version. But it is the future. It's where we're going, and that's where they're concentrating all their money and effort into. So that's an option. I have quite a few clients that use online, and I have quite a few clients that we use desktop for as well. Sage is probably outside of pretty much every small business reach anyway, as far as costs go. I mean, they're super expensive, and so are NetSuites. You could be looking at $50,000 a year just for the software. So it's stupid. It's good for probably a upper mid-tier business where you've got, especially if you're doing, manufacturing, inventory controls, all that kind of stuff. Intact is a kind of a good alternative to QuickBooks Online. It's an online version. And Peachtree was like one of my favorites. That was pre-QuickBooks. They were the QuickBooks of the 90s, and then QuickBooks kind of took it off. I still have some clients that use Peachtree. And I even like it better than QuickBooks Desktop because it's an actual double entry accounting. You got to understand that to do that. Zoho is one that kind of is getting a little bit more and more popular. But Iris is different than the other ones. It used to be called Accountant's World. It's an online product as well, but it's built so all these other ones, well, QuickBooks, Intact, Zoho, what's the other one? I can't remember the name of it, but they're built for you, right? So they build this accounting software and they say, look, you can use it, it's easy, and we've got it pretty user friendly, and you can do it. But you're in charge of the setup. You better set up your chart of accounts right. You better do all the setup correctly, because if you don't, it's just a train wreck. Iris is different because it's built for accountants to give clients access. So we would control it. And in fact, Iris is what we just are starting to migrate to that internally in our office. So any new clients, stuff we're doing it in Iris and giving our clients access versus them getting QuickBooks Online and giving us access, because we control it, set everything up, and take care of it. That way we can ensure that things are set up properly. And I'm honestly trying to move away from QuickBooks just because of what they've done internally, their marketing campaigns, their different things that they're doing. I was talking to a CPA in California one time, and he goes, the problem with QuickBooks is they made everybody think they can be their own accountant. And I'm not trying to say that we're the end all be all, but because I've got plenty of clients that aren't accountants and their books are great. They take care of things, they do them right. I met with a guy today who is a construction guy down in Park City, Camas area, and big operation, and he does most of his stuff in his books. I have access to him and I get in there all the time, but he does a great job. So I'm not saying it's not impossible, but it's just super important. Because I'll tell you, if I get a QuickBooks file at tax time to do a tax return from and it's a train wreck, I don't want to do it. And it's going to be the last one on my list, and it's going to cost you a lot more than it would have if the books were done right. So we're moving to accountants world or Iris, yeah. Square? Square's great, especially for processing payments and stuff. Their reporting's good. Yeah, it is good. Yeah, I mean, it all in any of these softwares, it always comes down to the setup, right? Square's good from a point of sale side. It's not a full accounting suite, so you can't record your transactions and all that stuff in there, but it'll track your inventory. It'll tell you what your sales are and all that stuff, and that can all be journalized into your accounting system or whatnot. But I have a lot of clients that use Square. It's not bad. The thing to get worried about, and Square's not too bad, but it's the transaction costs, how much it costs to run those transactions. So if you just had a merchant account somewhere, you can usually find a much better rate than what Square or Swipe or those ones are offering you, whether at a bank or another, person who does merchant accounts. So you can set up your own terminal in your office and run your credit cards. A lot of them you can even do online and do those things. So there's a little bit higher cost to a Square. And if it's really good and taking care of some headaches, especially on the revenue side of things, especially if you got a bunch of different classes of revenue, right? So especially with inventory, right? To be able to track your cost of goods sold and stuff like that on there. I like it. That's good. But it is the cost of doing the business in that thing, right? Cool. Okay, so after we get past all the accounting, the good, boring stuff, nobody fell asleep in here, so that's good. Employee versus contractors. This is usually a really hot topic, and the IRS loves to audit the crap out of this stuff. This is the stuff they really like. And the reason being is because of the payroll taxes, right? So the IRS has 3 tests. So if you're looking to hire somebody to do something for you, you got to look at it in this 3-pronged test to see how you should be treating them, whether you're going to put them on payroll and pay payroll taxes and withhold and go through all the nightmare that payroll is, or if you can just give them a 1099 at the end of the year and they got to worry about it on their own, right? So the first is behavior. Do you control their work, the worker's time, their work life, the tools? So, right, mechanic shop's a great example, right? I come to you and say, hey, I need a job. And you say, okay, you can bust tires, change oil, do brake jobs, easy things. But I use your tools. I'm there. You tell me when and where to be there. You're controlling that. You're not gonna pass that test from a contractor standpoint. I'm gonna be an employee, right? The next is financial control. So the compensation structure, so how that is. So it's salary, wage, commissions. Is it based on the project? It's one thing for you to come and say, hey, I want you to do this transmission job for me, but I can bring in my own tools. I can do it whenever I want. You might say, hey, look, the client's hoping to get this back in 2 weeks. Okay, great. I come in and do it when I want. Well, you're not really controlling my behavior. Give me a place to go do something. Maybe we can get past that. And I get paid based on a commission or whatever it is that the job that I'm doing, something like that. And the next is the type of relationship. Who dictates how and when the work gets done, right? It'd be really hard for me to tell all my staff right now that they're contractors, so I'm going to 1099 them. Well, they'd probably all quit, number one, but they're working in my office, on my computers, on my software, on all that stuff. So if they can't pass all three of these tests, more often than not, they're going to be an employee, which means then you got to go through all the payroll bull crap, right? And I guess that's where we'll go next. An employee. So if I have an employee, FICA and Medicare, right? So everybody here's had a job or has one now. If you look at your paycheck, there's 3 taxes on there. And my favorite line from Friends, did anybody, you guys watch Friends? Rachel gets a job and she's like, my paycheck was nothing. Who the heck is this FICA guy? Right? And so that's what Social Security is FICA, right? And on that, if I get paid whatever my wage is or whatever my salary is, the FICA rate is 6.2% per person, the employee and the employer. So I take 6.2% out of your paycheck, and then I add another 6.2% from my checkbook and send that off to the IRS. So the IRS is getting 12.4% just in FICA, okay? Medicare is another 2.9%. So 1.45% paid by you, 1.45% paid by the owner. So the IRS is getting 15.3% in employment taxes on your wage. That's not even income tax, right? That's just employment taxes. So then going back to sole proprietor, partnerships, those kinds of things, when I say you got to pay a self-employment tax, what you're doing is you're paying FICA and Medicare, but because you're both the employer and the employee, the self-employment tax rate is 15.3%. So on your tax return, if you look at it, if you've got net profit on your Schedule C, say it's $10,000. And then that flows over to my 1040, so I got to pay income tax on that $10,000. So we calculate income tax. And then there's a separate schedule where we calculate the self-employment tax, and it gets added into your tax bill. And that tax rate's 15.3%. So this is where tax planning comes in, because how do I mitigate or get rid of or change what that self-employment or FICA and Medicare tax is as a business owner? Because when you're self-employed and you're set up as a sole proprietor, single member LLC, or a partnership in some ways, you got to pay not only income tax on your portion of the profits, but you've also got to pay the self-employment tax. And that shows up on your personal tax return. Okay? And then, if it, add insult to injury, the employer also has to usually cover what's called unemployment taxes and workers' comp. That's not charged to the employee. That doesn't come out of your check at all, but the employer has to pay that. So when somebody comes into me and they say, okay, I'm looking at hiring somebody, I'm like, okay, what are you going to pay them? And they go, I'm going to pay them $20 an hour. And I said, is that their wage? And he says, yeah. It's okay. You need to add 15% to that on what it's going to cost you to employ them, right? Because you've got all these taxes. You got FICA, you got Medicare, you got unemployment, you got workers' comp. And when you're just an employee, and have been, it's really hard for them to get out of that mindset of what it really truly costs for you to hire somebody, right? I've had this discussion many times. It's like, well, you bill me out at X amount per hour and you're only paying me X amount per hour. Look at all this profit you're making. And I'm like, good criminy, all the payroll taxes, the desk you're sitting at, the software I'm paying for, the rent on the business, the utilities, all that stuff eats up that profit super quickly, right? So that's how you've got to decide where I'm going to set my sales prices at. I got to have a profit margin. So I got to be able to back into what does it truly cost me to run this business? And when you're dealing with employees, that's the hardest thing, because it's really not as cut and dry, right? It's a little harder. So understanding what these rates are and different things. Some businesses, like a business like mine, I don't have to have workers' comp in the state of Wyoming. I can get a workers' comp rate that's clerical. It's usually pretty low because there's not a lot of risk to somebody going to get a paper cut in my office. What do I need workers' comp for? But a mechanic's business, freaking car could fall off the lift and crush somebody, right? fact, that guy I was telling you about down in Utah, he had a guy fall off of a roof last year, broke his collarbone, broke his wrist. He's never had a claim. And in Utah, they have private insurance for workers' comp, right? You got to go get that from an insurance company. His rate is usually about $22,000 a year for his workers' comp. This year's $45,000 because of that one accident, right? So you got to be really careful when it comes to that kind of stuff, which is why you got to have good insurance. You got to be structured properly so that you don't get sued or lose everything in a lawsuit. Like, there's a lot of crap that goes into owning a business that most people don't think about. So then the difference then is then if I pay you or you're paying employees, you're going to give them a W-2 at the end of the year to report that. And on that W-2, there's 6 boxes. Well, the main 6 boxes, your income for income taxes. Box 1 is what goes to your income tax return. Box 2 is how much you had withheld for income taxes. Box 3 is what you pay, your Social Security or your FICA wage was, and then how much FICA you paid in Box 4. Box 5 is the Medicare wage, and the Box 6 is the Medicare taxes that you paid. There's a couple, I'm sure some of you have probably looked at your W-2 and you saw that Box 1 is different than Boxes 3 and 5. Does anybody know why? Nobody knows why? Alec, you know. Yeah, so retirement usually, right? So if I put money into a 401k plan, I don't have to pay income tax on that if it's a traditional 401k, but I still have to pay the FICA and Medicare because when I pull that out in the future, I only have to pay income tax on it, right? So I can't contribute to a retirement plan unless I have earned income that I paid FICA and Medicare on, right? So you can't contribute to those plans without earned income anyway, right? I have to have a W-2 or self-employment earnings in order to put into a retirement plan. I can't contribute if I don't have that, right? Okay, if I'm an independent contractor, now kind of more like you guys, if you're going to start a business, you're independent contractors, right? Your net profit on your Schedule C, I got to pay income tax on, but I also have to pay 100% of the FICA and Medicare, so both sides of it. You look confused.
This is my first year ever having my own business. I always had a job. This is my first year ever having a business using, normally I have a full-time job, and now I don't, so I just have a business. You need to tell me if I pay FICA and Medicare?
On the net profit.
Even if I don't have any employees?
Yeah.
I'm not even an employee.
Yeah, you are. You're the employee. You're the employee. So when you work for somebody else, right, it's a job, it's earned income. If I start a business, that's earned income. So I've got to pay the FICA and Medicare on what my net profit is. So let's say you bring in $100,000 of gross revenue. That's not what you're paying FICA and Medicare on. You're paying it on the net profit. So after all of your expenses, whatever your profit is what you got to pay the FICA and Medicare on. And that's a great question. Then it also depends on income limits and stuff like that on whether or not we're going to get hit with it. There's also earned income credits, child tax credits, different things that can help offset that stuff if you're at a certain level. I have a few Schedule Cs where they should be converted to like an S Corp or something like that, and they don't do it for whatever reason. But for the most part, I like to start out as a single member LLC, just like you are, or a partnership like there if there's 2 or more. And then as the profit starts to raise to a point where I could pay myself a wage that's less than what my net profit is and only pay FICA and Medicare on my wage versus the whole net profit. But until then, especially in a single member, because if you go to an S Corp, I've got a whole other tax return I got to file. I've got to do payroll because now I'm a corporation. I've got to pay myself a paycheck. So even if I'm the only one on payroll, I've got to do all the payroll filings, the quarterlies, all that fun stuff. There's a cost to doing those things. So I want to make sure when I'm doing planning with my clients that as their net profit grows, I wait until the IRS can pay for that conversion, right? Because if I don't make the conversion, my tax is going to be here. If I make the conversion, my tax is going to be here. So all that tax savings, I can use a portion of that to pay for all this extra stuff I've got to pay for. So very rarely out the gate do I say, let's be an S Corp right now. Sometimes I do, but for the most part, I start them out as single member LLCs and then convert them when they're big enough, when they're making enough. And, you know, if you're buying assets, doing stuff like that, we've got depreciation expenses that we can accelerate and do different things to keep that tax low. And that just goes into the planning of the stuff. And this is a big one for you guys. If you're renting from somebody for your location, you have to give your landlord a 1099 on how much rent you paid them. These 1099 laws are getting more and more strict too, because you probably have noticed, like with credit card companies and that, all of a sudden you're getting 1099Ks, 1099 miscellaneous, 1099 NECs, all these different 1099s that are out there. And I tell my clients, all my business owned clients, I'm like, if you've got it, and you can get penalized for having not given the 1099 to who you got to give them to. There's penalties for the businesses that don't issue 1099s, especially if I've got a lot of contractors, right? So I have some dentist practices and different things where they have specialty guys come in, like an orthodontist or, you know, a surgeon or something like that. They're not employees of this dentist, but they come into his office, they see his patients, they do these different things there. We got to issue 1099s to these guys because they're independent contractors, right? That's the big one. But even people like rent, if you've got a landlord, you should be giving them a 1099. I paid you $10,000 in rent last year, right? I had one guy get audited, and we'd been doing 1099s, but we didn't do one to his landlord. And the auditor brought it up and said, you really need to be doing, didn't penalize us. They let us go as long as we started doing it. But you got to be aware of the 1099 rules on that. Yeah.
The business that the person that we're renting our place from is requiring cash. So we're taking the cash out of the business. We still send him a 1099?
Yeah. This is where it gets crappy. Holy cow. Okay. The reason they want cash is they don't want a record. They're not paying tax on this. So I run into this a lot too, because like at the end of the year when I'm going through people's books and I'm like, hey, I can see that you've got some contractors on here. You need to issue 1099s. And then they go to the guy to get the 1099 info. They give them, because they need to fill out a W-9 for you to have on file, right? So the Form W-9 doesn't go to the IRS. It's for your possession. So you hire a contractor, give them the W-9. They give that back to you because it's got their name, tax ID number, address, all that stuff on there. And then we have that on file to say, okay, I paid the guy 10 grand this year. Here's his W-9, so I know how to prepare the 1099 and give it out. But what they run into a lot, especially if they're no longer doing anything for them, they don't want to give up that information. So I'm not giving you that. So I tell my clients, like, if you hire a contractor, you do not pay them until they give you that W-9. Don't pay them. Because once you give them the money, you have no leverage. Right? Now, in the case of your landlord, oh, geez. I mean, because technically in an audit, if you're deducting your rent expense, as you rightfully should, you're paying it, but you don't issue a 1099, they can disallow the deduction because they're not picking it up as income, right? That's the problem. You took a deduction and they didn't pick it. Kind of look at it like, if I give money to you in a business setting, I'm going to deduct it and you're going to pick it up as income, right? But if I take a deduction and nobody picks it up as income, that's what the IRS hates, right? That's why they hate contractors. They absolutely hate them. And then the other problem with contractors are, and it's not a problem, it's just, let's say I get $1099, $100,000 for a job or something. And then I say, well, it cost me $50,000 to do that job. So I'm only going to pay tax on 50 grand, right? Because I'm going to take the deduction. If I had done that as an employee, I'd get a W-2 for 100 grand. And my expenses don't matter, right? So that's why the government wants everybody to be an employee. They hate contractors. They absolutely hate them. I don't know. I would tell your landlord, say, hey, I was talking to my accountant and I'm supposed to give you a 1099 for rent. Can I get your information and just see how they squirm? I would do it for entertainment value more than anything. Well, I mean, you could document it as such, and I would, in your records, I would say this is rent being paid. Like, I'd almost ask the guy for a receipt at least, but I'd be like, I got to support my rent, you know, but technically I'm supposed to give you a 1099 miscellaneous in the rent box on how much I paid you in rent. It is, yes. Rent is if you've got a lease, and I've got 10. That's your receipt, right? But the problem is the non-issuance of the 1099. If you were to get audited, you could get penalized for having not given your landlord a 1099, right? Which sucks. I know. I hate. Doesn't the IRS just suck? And they're so bad to deal with. They're so hard to talk to right now. Absolutely hate them. So I started in 99 at PwC, and up until last year, at the firm I worked at in Salt Lake, we had one full-blown audit where they go through everything. And then in 2018, I had one client get picked for audit, and it wasn't because of anything we did on the return. In fact, the auditor came in and said, "You just won the wrong lottery. Your tax return looks good, but we're going to go through everything." Because like, dude, you blew your whole wad on the wrong lottery, man. That sucks. Which is a nightmare to do that. This year, I've got two. I mean, they are, kind of those fears that we all had when Biden said he was going to hire 88,000 agents. It's starting to. When I went to training, I got to go to training every year. I have to get 40 hours a year of training. So I was down at training, and the presenter was out of California. He's a tax attorney out of California who also has a tax practice. And he just, right off the bat, he goes, "Are you guys seeing more upticks in audits in your practice?" And there's 1,500 of us in there, and I'll bet you 95% of us raised our hand. He's like, "Yeah, I had maybe 6 audits in 20 years, and now I've got like 15 going on right now." I mean, it's just nuts. And they're the worst people to deal with. They don't understand what they're doing. They're holding you to a standard that was set in 1986 with the tax law in 86. Well, that was before the internet. That was before online banking. That was before apps and all that stuff and how we collect and spend money. And they still hold you to those receipt standards. My God, you better have that Starbucks receipt or you're going to be in trouble. So anyway, cool. All right, so this takes us into payroll compliance, and we've kind of touched on this a little bit. If I have employees, more often than not, I'm going to have to file quarterly forms for that. That's the Form 941. That's where I'm going to report how much wages I had that quarter, how much I withheld in income taxes off of my employees' checks, and how much FICA and Medicare I withheld and have to match. And that should be being paid in either monthly or after every payroll. So this 941 just summarizes what you've done for the quarter. Sometimes you can owe money with the quarterly if you haven't been submitting the payroll taxes that you owe. And if I could tell you to never be, if I could pick one thing to never be behind in the tax world, it's payroll taxes and sales taxes. But payroll taxes especially, they're just a nightmare. They suck. You've also got to do your in Wyoming, we got workers' comp and unemployment. That's state run, so we file those forms with the state and pay those in quarterly. And then the annual 940, that's the federal unemployment. So you have state unemployment and you also have a federal unemployment. That's an annual form, not quarterly. And then you got to do your W-2, W-3 filings, so you can tell everybody how much they made and everything they did. And then you've got your 1096 and your 1099 filings. So if I've got any contractors that go out on 1099s, the Form 1096 is it's the summary form for all of your 1099s, just like the W-3 is the summary form for all of your W-2s. So you've got to do all this payroll compliance. So that kind of brings me, how late do we go? 8? I mean, yeah. So that kind of brings me through all like the compliance, all this headache of running a business, at least from a accounting and tax perspective. So like the next thing is that I just said, usually open it to questions. And usually when this is coming into tax time, I usually get a crap pile of tax questions. So I'm happy to answer them. So whatever you got. And if you guys are quiet this year, I'd be shocked. This is your time. We ought to just give Rachel a microphone.
So is it, so if you pay somebody more than $600, is that?
That's a good point. Is it what? No, it's still 600. So if I have a contractor, if I pay something, and it's not a single instance, it's for the whole year, right? So if over the whole year I paid somebody as a contractor more than 600, I got to put them on. I got to give them a 1099. Unfortunately.
That's so many questions. So we're the owners, we're the only employees. So what we think we're supposed to do is like an owner's draw. We're not technically
You're right.
employees, correct?
You are correct.
So we do a draw.
Okay.
Ish.
Maybe. So, okay.
How do we get money?
Great question. You're a partnership, correct?
Yeah.
Okay. You're an LLC taxed as a partnership, right? You didn't make an S election, so you're a partnership. So the default form is 1065, which is the partnership tax return. Okay. So in a partnership, as owners, you're not supposed to take payroll. You're correct. This is stupid. This is one of the dumbest IRS laws, but this is stupid. You're supposed to, okay. I just don't want to get too far into the weeds. Sometimes I just start sounding like a nerd and you just tell me to shut the hell up. So you guys perform a service for your company, right? What is it you guys do? Coffee shop. Great. Okay. So you're there working the coffee shop. Yes, you are employees. You're the owner and the employee. Okay. So you guys, if you decide between the two of you that there needs to be a wage involved, right? You could be 50-50 owners, but let's say one or the other of you is doing more work in the business, right? It happens a lot, and maybe not in your guys' case, but it does. So they'll say, look, I want to get compensated for, I'm here doing all the work every day. You're just a 50% owner. You put 50% in and you think you own the place. Well, they kind of do. But so what you do is you take what's called a guaranteed payment, okay? This shows up on the K-1. And how it does is on the partnership tax return, I get a deduct to get to my net income, my guaranteed payments, because those are wages that we paid to the owners, right? So let's just say you did $10,000 worth of work. We're going to deduct that not as a draw, because draws go to the balance sheet. Draws come out of your equity section on your financial statement. Those come out of the equity. But if I've got payroll or guaranteed payments, we deduct the guaranteed payment as if it's a wage. But I have to specify on there who got the guaranteed payment, which owner got it, okay? So then on your K-1, how do I do this easily? Let's say you have, to make numbers easy, let's say you have $10,000 of net profit, okay? So first you had, let's say you had $50,000 of revenue, we had $30,000 of expenses, and then on top of those expenses, we paid one or both of you $10,000 of guaranteed payments. We're going to show that as a deduction. So that brings us down to $10,000 worth of profit, right? Because we're going to deduct those guaranteed payments. Then you guys are 50-50. So your K-1s on the line 1 is going to show $5,000 of profit to each of you because we're splitting that $10,000, right, to get taxed. And then let's just say you are the only one that got the guaranteed payment. Your guaranteed payment of $10,000 is going to show up in box 4, which is the guaranteed payment line, so that you're actually getting taxed on 15, not just the 5, because you got paid the 10, right? Did I lose you? Okay, start over. No, but you do. The problem with guaranteed payments though is that because it is a wage, you have to pay the FICA and Medicare on that guaranteed payment. Whereas if you're just taking draws, your profit doesn't get reduced because it's not an expense. You're taking that out of your equity, so your profit stays higher, even though you've taken some cash out of the company. So what you guys have been doing is good. There's not a problem there. Doing a draw is great. As long as you're keeping it equitable, we're 50-50 owners, we're each getting the same amount. And in your structure, even if you didn't do it equitably, you just have to keep track of it. Whereas if we converted you to an S Corp and then you took it in a disproportionate way, that's where you could cause trouble. And that also kind of brings it to the S Corps. So S Corps, those draws, you have to pay yourself a reasonable comp, right? So if I'm an S corporation, I have to be on payroll. I've got to pay myself something so that I pay FICA and Medicare on it. But like if I'm single member LLC and I'm doing that, and my net profit starts to get up around 40,000 or so, that's when I kind of want to think maybe I ought to make an S election, because then I could go, let's say my profit goes to 50 grand. I'm getting taxed on that full 50 as if it's wages as well as income. So if I make the S election and I pay myself $3,000 a month and my payroll, so then I give myself a W-2 for 36,000. I would deduct that 36,000 from the 50, so my income portion is only going to be 14. My W-2 is going to be 36. So I'm still getting taxed on the 50,000 from an income tax perspective, but I only had to pay FICA and Medicare on the 36 that I did in my wage, right? And so that's where it gets to where you start to try and plan, when do I make this conversion? When do I make these changes? When do I do these things?
I'm gonna try to make this simple. I have a compound question.
Compound question.
Okay. Go back to the liability insurance. I'm a massage therapist. I have liability insurance.
Good.
Okay. If a person tries to sue me, my insurance is gonna take care of that.
Sure.
However, I use the money I made to pay for personal things for my own self.
Yeah.
Is that okay, or should I start paying myself a wage?
No, don't pay yourself a wage. What you would do is just don't pay for those personal expenses directly out of the partnership or out of the LLC. Move it to your personal account and then pay for it. Right? So if your bank ledger is showing Walmart,
Yes.
you bought a boat.
Yes.
What do you need a boat for in a massage business? And I got a lot of clients that buy a bunch of shit that they think should be deductible, but it's not. You don't go pay for that stuff directly out of the LLC account, because it shows on the LLC account that you went to the boat dealer and bought the boat, or you went to Walmart and bought your groceries, right? So but you could also say, well, I just took that $5,000 out of my account, put it in my personal account, then I went and bought the boat, then I went and bought the groceries, because you're not directly. That's what keeps that LLC in place. It keeps it bulletproof.
One other question now. When a person leave a tip, I use the Elevon to accept payments. It shows how much money I charge, and then it also shows how much tip I receive. But it's still going to my massage account.
Yeah, well, it is revenue to there.
It's still revenue?
It is, because it's coming. You're going to get a 1099 from that merchant account saying how much you got.
So I need to report them tips also.
Yes, but you know how you solve that?
No, I don't.
Tell them cash tips only. I mean, when my wife when we were in college, my wife was a server in college when we were both stupid and poor. And it was interesting how they handled it. Like, she would, at the end of the night, instead of counting out all of her tips, she would, and back, this is early mid 90s, right? So a little before all that stuff, but we'd count her out, and what they would do is they would just claim like 10% of their sales. So she'd look at her sales that night and say, put 10% on there. She always made more than that. God, I felt like the richest person on earth when she was a waitress, and then when she got a real job and got a paycheck, I'm like, where the hell did all the cash go? I got no money. And she was making a lot more money, with her degree. So, but yeah, in that case, I mean, it is risky, because those tips are coming through that, and it's going to show. I mean, you do need to pick that up as income, because it's going to be that. But if they give you cash tips, no way, don't just put it in your pocket. Go away. And I hope there's no IRS agents here tonight.
So the business that I want to do, involves food, and so my in-laws own a high hole.
Okay.
And so I was thinking of having them get the food from like Cisco, and I would pay them.
That's
Is
fine.
that an upward corporate bill in any way?
No.
Like, if
You're going to have some sales tax issues, though, with doing that, because your parents are buying that sales tax free, right? Because they're buying it for resale. So they have a sales tax license, I'm sure. When they go buy their food, Cisco's not charging them sales tax for it. They get to buy that wholesale. Because they're turning around, and when they sell it, they have to collect the sales taxes, and then they have to remit those, right? You should be able to buy those sales tax free. So I don't know, I'd have to think through, like, if I were doing your parents' stuff, I would want to, because he's selling you inventory at cost for resale. You're going to need to get a sales tax license anyway to do what it is you want to do. That's another pain in the butt thing, is sales taxes. So if you really thought about it, I mean, how much we get taxed? You have income taxes, property taxes, payroll taxes. Sales taxes are by far, to me, the biggest highway robbery system there is. I mean, it's awful. You're taxed to death. And if we were, if we were dumb and lived in California, throw another, 15 to 16% income taxes on top of that we don't have to pay for here. It's nuts. If you're in the top tax bracket federally in California, like if you're in the top tax bracket federally, you're paying 37% right now. The top tax bracket in California is 16. So 50, what is that, 51, 52% of your income right there is going to the state and federal government. I mean, no, and they don't have any water. Geniuses. Yeah. And you're talking about a state that thinks that we all should be on electric vehicles and they can't even power their AC units all summer long. It's a friggin' joke. Go ahead.
So along those lines with the state tax.
All right.
Sales tax.
Okay.
In my business, I've opted out of doing the tax exemption.
What do you do?
Mechanic shop.
You've opted out. So when you buy your parts, you're paying sales tax. Okay.
And then I just pass that through the customer.
That's fine. But are you charging sales tax on your labor?
No.
You should be. Wyoming sucks that way. In Utah, labor is not sales taxable, right? So if I take my car into the shop in Utah, I got to pay sales taxes on the parts that I buy,
Yes.
but I don't have to pay sales tax on the labor. In Wyoming, if you're doing labor on personal property, which means it's not real estate,
Right.
you are supposed to be charging sales tax on your labor and remitting that. And that would be great if they did, especially on labor. Because then if we didn't have sales tax on labor here, then you'd be doing it fine because you're not marking up the parts and you're not and you're paying the sales tax. That's why, like, if you hire a contractor to remodel your bathroom, right? And he gives you a bid, he's got to factor in there what it truly costs him to buy the materials because he's got to pay the sales taxes on that.
Right.
And he doesn't charge you a sales tax on his invoice to you because he's already paid it. And that's where it gets like, it's like a nursery, for instance. Let's say I owned a nursery and I'm selling plants and stuff. You come in and buy from me to put in yourself. I got to charge you sales tax on those plants, right? But instead, let's say you came and said, hey, will you design my backyard and go and put it in? Great, I will. Then I'm taking inventory that I bought without paying sales tax on it and going in and installing it in your real estate, which I'm not supposed to charge you sales tax on. So on my sales tax return, I have to charge myself what's called a use tax. So a sales and use tax is really what the form is. If I buy something sales tax free because I'm sales tax exempt and I'm using any of those products in my jobs, I've got to pay the use tax on it as if it was sales tax. So that's where like with a nursery, I was just doing this not too long ago with one of my clients. I was like, okay, you do installation jobs? And he's like, yeah. And I said, okay, I don't want you to mark up your materials to your clients. I want you to charge them what it cost you to buy that plant instead, so that we only have to remit a use tax on the cost, not on the retail, and then charge the rest on labor because it's all in real estate, so we don't have to do sales taxes.
Right. In a business where you have a lot of money tied up in stuff that you bought for stock that's not sold.
For stock, like in the stock market?
Yeah, it's on the shelf.
Oh, inventory. Okay, yeah.
Yeah. So those businesses, I'm going to use Napa for example. They've got, let's just say, $1 million in stuff in inventory.
Yep.
If they paid sales tax on that, they would have to pay that sales tax and have it sitting on a shelf for God knows how long.
Yeah, and that's why they don't pay sales tax when they buy it. Yeah, you're not. So I'd be shocked if any part sitting in Napa's shelves they paid sales taxes on. They should have bought it tax free or sales tax free. But that does bring up another accounting issue that I think a lot of people don't understand. I've had clients come in and say, "Oh, I just bought a bunch of inventory on December 31st so I could get a deduction." I'm like, "No, you didn't." I said, "All you did was convert one asset. If you look at your balance sheet, I took cash out of my cash account and I put it in as inventory as on my asset. I don't get to expense that inventory off until I actually sell it." And so matching that is the key. And because there's a saying, especially in retail, it says, "I don't want all my cash sitting on my shelf," right? Because it's a lot harder for me to go and convert a loaf of bread to cash as it is to just go to my bank account and take the cash out. So you got to be careful with your inventory. That would affect you a little bit.
I do it the way I think, from what I understand, is I do it the way where I don't charge the sales tax on parts to my customers, but I go through Square, and Square automatically
The whole
charges
amount?
the labor taxes.
Good.
Labor.
So it gives you a report for you to be able to submit on your sales tax return.